How to boost your credit score 100 points plus in 30 days without credit repair. Day number 10. How to pay down debt. Knowing which revolving debts to pay off first matters. I'm going to go over two different approaches. Which you choose will depend on your need and how well you know yourself. The first approach is called the Snowball Method. The author actually uses this method personally because he knows himself. He needs to see results quickly or he'll lose interest. Here's how the Snowball Method works. List your revolving debt in order from lowest balance to highest balance. Make the minimum payment on all your credit cards except the one with the lowest balance. Any extra income you have is used to pay down this balance first. Once the card is paid off, then take that same money you were using to pay off the first card and use it to pay down the second card. This works because you have a larger and larger sums of money to knock down your debt. From a psychological point of view, it's very rewarding to see cards with zero balance accumulating, as well as having large and larger sums of money to drive your next balance down. While extremely effective, the Snowball Method is not the best method for improving your FICO scores. Most people assume that paying down the card with the highest interest rate would be the next logical step, but that's incorrect. You need to think like FICO and understand what FICO considers important. When calculating your credit scores, FICO takes 4 criteria into consideration. 1. Overall combined utilization. 2. Line item utilization. 3. Number of accounts with a balance. 4. Number of highly utilized credit cards. Utilization just means how much of your credit you're using. For example, if your credit card balance is $500 and your limit is $1,000, then you're utilizing 50% of your credit. Utilization is the most heavily weighted factor when it comes to your revolving debt. Your overall combined utilization is the total of all your revolving accounts, credit limits, compared to the balance you owe on those same accounts. So let's say you have 10 credit cards, each with a $1,000 limit. Your total revolving credit limit is $10,000. Now let's say 6 of those credit cards are maxed out. This leaves you with $4,000 of available credit, meaning that you're about 60% utilized. Your line item utilization is for each individual credit account. So if you have a Chase credit card with a $1,500 limit and you have a $1,500 balance, then you are 100% utilized on this account. The number of your credit card accounts with a balance is just like it sounds. It's good to have credit cards, but it's even better to have credit cards with zero balance. If you're close to maxing them out, FICO will adjust your credit score accordingly. If you're close to maxing them out, FICO will adjust your credit score accordingly. Once you know what FICO deems as important, it becomes easier for you to create a strategy to properly pay off revolving debt. So now take out the spreadsheet again. First, you'll want to pay off any cards that you have low balances on. Remember that using too many cards is not a good thing. So always keep at least one card at 0. Next, you'll list your lenders in order of highest utilization to lowest. For example, your payoff priority list should look like this. 1. Citibank. 2. US Bank. 3. Macy's. 4. Shell. 5. Sears. Citibank is the first because the amount owed is small, and having a credit card account with a zero balance will increase your score. The other revolving credit cards order was based on the utilization percentage of each card. This is how you hack FICO's scoring formula to optimize your credit scores. You will start to see a credit score increase in about 30 to 40 days. Lenders only update their records with the credit bureau once a month. The date they update is normally about 10 days after your due date. It's important to note that using your credit cards while you're paying them down is counterproductive. Day 11. A zero balance letter. Here's a slick trick for realizing a faster credit score increase after you pay off each credit card. It's called a zero balance letter. 1. To confirm your last payment cleared with your bank. 2. Contact the customer service department of the credit card company and tell them that you're applying for a home loan and need a zero balance letter. They may insist on mailing it, but try to get them to fax it to you instead. There are dozens of websites that will give you a free fax number and add up to 10 free faxes a month, like efax.com, for example. Once you have your letter in hand, simply mail it to each of the 3 bureaus. Your records will be updated in about 2 weeks. Want to speed up the process even more? Here's what you need to do. Apply for a home loan. If you don't have a trusted mortgage consultant, then email Brian at howtofixmycredit.com. That's the author. And he'll set you up with his mortgage consultant. Now you have 2 options. Option 1, your mortgage lender can perform a rapid rescore. This will provide the third-party credit service they used to pull your credit with your zero balance letter. The third party will instantly update their records and notify the credit bureau of the change. The credit bureau will reflect the change in about 24 hours. Your mortgage consultant may charge you for a rapid rescore. Option number 2. Contact the credit bureau directly. Tell them that you're applying for a home loan and you need to fax a zero balance letter. They will give you an unpublished number after they verify the mortgage inquiry on your credit report. Check your score in about 48 hours and you will see the change. Note: yes, a mortgage inquiry will hurt your score, but the zero balance letter will more than offset the inquiry. Besides, you're only doing a pre-qualification. You won't actually be submitting your application to lenders who would each need to pull a copy of your credit during underwriting. Using this process may realize a huge credit score increase in 24 to 48 hours from start to finish. Day 12. Reviving old accounts. Another often overlooked strategy for improving your credit scores is to reactivate old accounts that were in good standing when they closed. Someone closes an old account because they weren't using it and their scores dropped. Other times, a creditor closes an account due to inactivity. In either case, it's sometimes possible to reopen the account and recapture the benefit of the older trade line. Often, these accounts can be reactivated even if they've closed for several years with just a phone call. This can be good, low-key, and cheap way for you to add to your high credit limit. I'll go back. So this can be a good, low-key, and cheap way for you to A, add to your high credit limit, B, improve your debt to credit ratio, C, increase the average age of your revolving accounts, and D, all while getting another good account added to your credit report. Day 13. Increase your credit limits. One of the least utilized strategies for lowering your debt utilization is a credit limit increase. All you need to do is call your lender and ask if a credit limit increase is available for your account. In fact, the author just called Capital One this morning. I don't know if it was this morning, but reading it, that's what it says, to inquire about changing his account from cash rebate to an account that earns miles. They told him both his accounts qualified for upgrades. They dropped his increased his rebate on one card, and changed the second to one that earns him miles. Most people don't know that a customer service rep will pull up your entire credit account before they even answer the phone. They use caller ID to identify you. Then you have to prove your identity. Once proven, they have all your past conversations, your limits, balances, and possible upgrades available. They just won't tell you unless you ask. By requesting a credit limit increase, you're effectively increasing your available credit without increasing your balances. For example, if you have one card with a $500 limit and $250 balance, then you're at 50% utilization. If you get a card with a $500 limit increase, then you have a $1,000 limit with a $250 balance. That brings your utilization down to only 25% instantly. The lower your utilization, the higher your scores. With a secure card, you can simply increase your deposit. For a regular credit card, make sure you make timely payments for at least 6 months, though 9 months is better. Make sure you keep your cards under 50% utilization on all of them. They won't approve you if you're maxed out or have missed payments within the past year. If they ask you what you're going to use the money for, don't say gambling or anything irresponsible. Say you're trying to improve your FICO scores, or that you just got a raise and wanted to buy some new furniture. If they ask how large an increase you would like, ask them how much you qualify for. They can tell you after a minute or so. If you're approved, then you just raise your credit scores with a phone call. And then I'll stop there. So next video is going to be starting on day 14.